But over the past several decades, one of the problems that we've had in the US, and this goes before even the bubble, is that there's a number of major, let's call them superstar cities, right? The Los Angeleses of the world, the San Franciscos of the world, the Seattles, Bostons, their supply became less elastic over time.
All right, I'm really excited today for this episode. We have Lance Lambert on. Lance Lambert is the co-founder and editor of Resi Club. It's a media and research company dedicated to in-depth tracking for reporting and analysis of regional housing markets in the U.S. First of all, if you're watching this or listening, go ahead and follow Lance on LinkedIn or Resi Club. That's how I found Lance, and I really like how the information and data is broke down into like very digestible charts that's like applicable. And Lance, I really came across you from the Affordability podcast you did about 2 months ago on the U.S. housing market. And anyway, just want to introduce you. And how are you doing today?
Doing great. Housing. There's always so much going on in the U.S. housing market. And we're at a really interesting time. I would kind of describe this as, a significant chapter for housing, where we went through the pandemic housing boom of an overheating of the market, prices ripping. That was followed by a mortgage rate shock. And we've just had a housing market where the prices and rates had moved so quickly, so fast, that incomes just need time to catch up. And so that's the jarring effect that you've felt in this housing market over the past couple of years. And that's still an effect that's going to linger over the housing market, even as affordability improves a bit, even if rates come down a bit, like we've seen. There's still that affordability strain on the market.
That can be broken down in, I've heard you talk about this literally for 10 minutes without being interrupted. So you have home prices being expensive compared to what people are making. I personally don't see that getting too much better anytime soon. You also have maybe people sitting on homes. You have the people that really want to buy the homes, maybe priced out, stuff like insurance. So can you kind of dig a little bit deeper into why you see this? I know we had the boom with COVID and whatnot, but here we are and rates shot up, and then you have rates just recently come down a little bit, but it still feels like there's like this standstill and there's not as much activity that people are kind of expecting.
You're going to hate me for this because I'm going to go way back and then I'm going to work my way to it. But over the past several decades, one of the problems that we've had in the US, and this goes before even the bubble, is that there's a number of major, let's call them superstar cities, right? The Los Angeleses of the world, the San Franciscos of the world, the Seattles, Bostons. A lot of these markets, their supply became less elastic over time. They were producing less supply to meet the demand in those markets. They weren't, building multifamily where maybe they should have. And they constrained even the single family building in some parts. And so those markets have a lingering issue of zoning that has been multi-decades in the work. Then the second part is we had a housing bubble, quote unquote, in the mid 2000s. A lot of that was spurred by the mortgage products, of course, helped to accelerate at the end. There was a lot of migration across the country into these second and third markets that kind of spilt over out of those superstar cities. But what occurred, and let's just kind of forget about what created the bubble, but at the end of it, when it busted and we had the great financial crisis, we also, because we were concerned about the mortgage market, we not only got rid of all the products that were like, the teaser rates and, the ninja loans and all of this stuff, right? But we also changed lending standards and knocked a lot of people out of the market that used to be able to buy even before those mortgage products of the mid-aughts. That tightening of mortgage, the lending there, created a shock that was additional on top of the correction and crash we were already having. And so home prices fell even further, and you went from correction to overcorrection, and prices got too low that single family home building was just killed, right? For years, it was just so low. And so many of the people working in single family home building, not just for the builders, but also all the companies that make lumber, windows, all of that stuff. And so as the market started to come back in the mid 2010s, 2014, 15, 16, 17, single family was only slowly going up because the building capacity was knocked out. And you can't just ramp up and build millions of more homes. It's a steady process, right? You have to have the site managers, you have to have the general contractors, the subcontractors, all the companies producing the goods. So you can only move up so fast. And so what occurred in the 2010s is we just didn't build as many single family homes as we should have, because we not just had a correction, we also had an overcorrection. And so that's the second part. So both of those have impacted the supply, the actual total housing stock. Now, the third issue, this is a different one, which is demand is more elastic than supply. And elastic means it's an economics term for how much something can change, right? And so during the pandemic, when it started, very quickly, the housing market started to take off, right? Housing demand increased. All the stimulus, the ultra low rates going to low threes, high twos. And then there's the work from home effect. And so you had a lot of the people who were stuck in these very high cost superstar cities, the San Franciscos, the Seattles, the New Yorks, the Bostons, they spilled out, right? Because work from home arbitrage became a thing where you could go from earning in a higher market and buy somewhere else, right? Disconnected. The traditional metropolitan area is really just two things. It's a housing market and it's a job market. But suddenly people could buy from San Francisco's job market into Boise or Austin or Phoenix's housing market. And there was another part of that accelerated demand, which is even the people who stayed in the San Francisco, stayed in the New York, stayed in these markets, well, they wanted more space because they were working from home. And so a lot of roommates decoupled because they're like, I can't deal with this person for 24 hours, right? Instead of what I used to deal with them with 5 or 6 hours. And so there was an increase in demand for space. So the stimulus and all of that, including the PPP, all of that, the ultra low rates, work from home, and the increase for space created a huge increase in housing demand. Because remember, demand, unlike supply for housing, because, in supply for housing, a lot of the supply in terms of the total housing stock is not just 10 years old, 15 years old, 20. Some of it's 50, 60, 70, 80, 100 years old. So it only moves slowly. Housing demand can move very quickly up or down. And so that huge move up in housing demand very quickly in the pandemic, what it did is, because supply couldn't react to it, it overheated prices. And so 2021 is actually the single biggest jump up for home prices in US history. There just was not enough supply relative to the huge move up in demand. And the Fed estimates, according to a paper they published in mid 2022, that new home construction, housing starts, would have needed to increase 300% to match the increase in housing demand. That's how enormous the increase in housing demand was during the pandemic. And so by overheating on prices and then the ensuing mortgage rate shock, that really just took affordability to this really stretched max. And so we'll have to work through some of this. I think that affordability is unnaturally high, and it will improve if you give it time, continue to build homes. New construction has actually stayed fairly steady for single family. If rates can come off a bit off of the highs, and they have, from the 8% that we saw in October 2023 to now we're kind of around an average of like 6.2 for Mortgage News Daily. So as that has occurred and home prices don't accelerate and they kind of just move a little bit sideways, maybe a little bit up in some markets, maybe a little bit down in some markets, but sideways, and incomes can get just above it, we can have a little bit of affordability improvement over time. And we have already started to see affordability start to improve a little bit. The peak of the cycle was October 2023, when the 10-year Treasury yield got over 5 briefly, and the average 30-year fixed mortgage rate for Mortgage News Daily topped out at 8.03. So slowly with time that can improve. But there's still that underlying issue from the first two parts that I talked about, which is a lot of these markets have not zoned to create the supply response to their demand in their markets. And so affordability in those markets even before the pandemic housing boom was moving up, right? And was starting to get high and strained. And then this underbuilding of single family that happened in the post crash for multi years. That's something that we're still going to have to work through.
I have a lot that I want to unwind there. And before I do, I want to get on insurance. And just so you know this, Lance, I'm 39. I got a friend. I'm originally from New Orleans, and I got a buddy. I saw him last Christmas. And now New Orleans is probably not a good example. It's maybe equivalent to like Florida. You've got a lot of risks for flooding, hurricane. His homeowner insurance a couple years ago was 2,000, and then it jumped up to like 6,000. Then the next year it was like 7,000. It keeps climbing up, and he's telling me, he's like, Fletcher, I'm not, not a doctor and attorney here. I'm glad I bought well, but I almost have to like sell it now because of insurance costs. So we've seen insurance costs increase, and it's not just like housing. I think this is kind of like an American thing right now, even like healthcare, anyway. Sticking to the housing market with insurance, what are your thoughts? I mean, insurance has definitely gotten more expensive, and it's creating a barrier to entry, I believe.
So what we've seen in the U.S. housing market is we saw an overheating on prices and a rate shock, right? For first-time buyers, they felt both of those, right? If they go out today because the rates have gone up so much and prices go up, they felt that. Homeowners have not really felt it as much, right? Actually, many of them benefited from rates going ultra low during the pandemic housing boom and then the increase in their equity. But where they are starting to get pinched is what I consider the echo pandemic housing boom. And so you had an overheating of prices, you had an overheating of construction cost. And so both of those are, echoing over into an increase in homeowners insurance. And so you do have the climate risk and all of that that's playing out in some of these coastal areas. But across the country, even these places that are very low risk, they are themselves also seeing a homeowner insurance shock. 2 years ago in the country, even when inflation was taking off, there was only one state that saw a double-digit increase in homeowners insurance in 2021, and that was Florida. Which has seen many double-digit years.
Yeah.
But last year, there was 26 of the 50 states.
Wow.
And so that's an echo of the original inflationary shock that is now echoing into homeowners insurance. And we've seen that in all the other insurance as well across the country, where there was an inflationary shock, insurance doesn't get it right away, and it takes time. And for homeowners, there's even an additional lag because a lot of these state commissioners who approve the insurance increases, they're political appointees, right? And because that they've slowed down this process of this shock, because, the cost to build a new home now is 50% higher than it was before the pandemic. And so if you're having homes that get destroyed, the cost of replacement is changed dramatically.
Yeah,
because a lot of these states have slowed it down. A lot of insurers have left these states. Now, New Orleans, it's interesting that you brought that up. They're seeing a lot of problems in their insurance market. And it's not just inflation, this lagged inflationary shock. There's climate risk. There's all these other factors, problems in their insurance market. And when you look at prices, you're actually seeing prices fall in a lot of Louisiana and some pockets of Mississippi. And I think a lot of that is tied to these inflationary shocks. And it's a hit to, like I said, homeowners are buffered from rates and prices, but they're not buffered from insurance. And for a single family landlord, that hits right to your cash flow, right? If your homeowner's insurance goes up $200, $300 a month, which does happen. I have a close friend who has a rental property down in Fort Lauderdale. And coming into this year, his went up $600 a month, property tax and insurance.
That's crazy.
That's an immediate hit to his cash flow. Now, he was still in the green. Not everybody will be with that. And so you could see some of that supply come on the market and some of these pockets where that occurs.
I really feel like it's hard for somebody that's starting out to buy a home right now. And I'll just use like my parents as an example. So let's talk about like in your early 70s. House is pretty much paid off, like in no rush to do anything. They don't need to downsize. They don't need to do anything. They certainly could, but like, why would they? And let's just say not them now. Let's just say, okay, that average lifespan is like 85. So you could look at a lot of these people in the same position. They might not do anything until maybe an event like a death happens. I'm going to tell you this too, Lance. I have a client from Seattle. She told me that she feels so bad for her son who's gone to college, got an education, worked the jobs, done everything right. She told me that she is giving her son his inheritance as like while she's alive so that he can put that as a down payment on a house. You talk to maybe like my parents and it was like, man, they were buying homes at 24, 25 years old, and it wasn't really kind of breaking a sweat. I'm not going to say they weren't doing the right things and putting themselves in a position. I just feel that a lot of the United States right now, and for example, maybe my parents, they're in a position where they could buy a rental property, which isn't necessarily a good thing for the person who's coming up. So I just see this like unaffordability for people that are trying to do the right thing getting worse and worse.
Especially in some of these parts of the country, as wealth has increased, as demand for some of these markets has increased, there wasn't a supply response to that as much. And they've gotten themselves into an affordability pinch. And some of that, of course, is from, maybe not enough supply. And another part of it is, just the tremendous amount of wealth and income, right, that's occurred. And now we have a lot more dual income households, and that, pushes affordability. And so when you have these affordability pinches, there's enough people still out there that can't afford it, even with it, because of these higher income dual households. And so, yeah, it's definitely an affordability strain. And when you look at a lot of the numbers, you will see that right now, what we pass through, it's not quite as bad as like 1981, the early 80s, when we got up to 18%, 17%, 16% mortgage rates. But one thing about that is that while, yes, on a monthly payment basis, in 1981 and 1982, it was worse than it's been the past 2 years. The thing that's also true is that their down payment one was very low because prices to incomes was much lower back then. It was only like 2x or 3x, right?
Yeah.
Where now it's like 6x, 7x, right? So your down payment is much bigger now. And as rates moved down then, because their interest rate was just a ginormous percentage of their monthly payment because they had 18% mortgage rates, as it came down and they were able to refi, as a percentage of their income, it went down significantly, right? In terms of their payment moved down really fast. Whereas now, if you bought at a 7.5% mortgage rate, right, and you get you refi to 6, yeah, that's going to be some savings, but you're still really going to be paying unless your income has went up a lot, that payment as a percentage of your household income is still really high. And so it becomes a little hard to compare over time. And then, the people who did buy in 1981, 1982, when rates got to 16, 18%, literally the entire course of their mortgage, they refied every few years because mortgage rates just went on a multi-decade move down. And I'm not going to say that mortgage rates can't move down in the future here, but if the economy stays resilient enough, it might not be, what people would hope for. And it's definitely not on par of a comparison with the 1981 multi-decade move down.
Kind of taking that into consideration, that I do believe it's super unaffordable and once again, I'm not really taking my position. I'm taking somebody maybe like 30 years old. It feels like it's kind of becoming a nation of renters. And so we're sitting at this point where you just had interest rates lowered. Let's say the majority starts to feel, and there's like and the reason I'm saying this is, let's just say, 2007, 2008, we had a crash.
Let me interrupt real quick. I want to make one more point, which is back to how the wealth has played into this. The example you gave of the mom who's pretty much giving him the money for the inheritance, that is part of the reasons that affordability doesn't improve, because there is the wealth there that can respond to it, right? And maybe that wasn't the case a long time ago as much. And so that's also a part of this, the move up on income and wealth in a lot of these markets.
If we go back to, let's say, 2004, 2005, and I speak to somebody who actually thinks like that's exactly where we are right now. And their thesis is basically that in order to have a 2008 type bubble, we need to have credit. Okay. So like we just saw interest rates drop a little bit, but maybe there are incentives that come along from the government because these cries get a little loud about like, hey, I am doing the right thing. I can't afford something. And maybe there's incentives that are throwing in that help kick off the cycle because lending standards, to my understanding, are probably still a lot more stringent than they were back in 2004. Going out 5 years, it almost feels like it's not going to get any more affordable for anybody. Depending, and each market is different. I feel like the people in Lance, you put something up like maybe 40% of American homeowners now are mortgage free or they're not buying with a mortgage. So it almost feels like the people that are buying are like the lady in Seattle that has the money to give. It's not the guy or the married couple that's 30 that has a new kid on the way and really needs to get out of the 2-bedroom condo that they're renting. It's like the lady in Seattle that's like, hey, I'm kind of sick of owning Microsoft, so like I'm going to buy another duplex right outside of Seattle. It feels like those people are more able to do that, which kind of further exacerbates the problem of people renting. And I just don't see a lot of those boomers, and maybe because they locked in so low rates that they're not really like downsizing. So a lot of these, I don't know, but over time, you posted something else that like now I think it was Gen Z or has more jobs than the boomers now. So just how that wealth plays out and kind of trickles down should be interesting.
A key point to keep in mind with this US housing market where we are right now is there's not much turnover in the housing market, in the existing market, right? A lot of people are holding on to what they have. And if you look at the numbers right now, we're at kind of like around like 4 million flat existing home sales is like where we're running at an annualized basis. That's on par with how many existing home sales there were back in the late 70s during that boom, right? And it's on par where we were in the mid 90s. But we're in a country where there's a lot more homes, there's a lot more people, and the churn in the existing market is just very low. And the reason for that is because affordability is not just felt by buyers in the United States, it's also felt by sellers, right? Because most sellers are also a buyer once they sell. And so that part of the market where people, sell their home and go out and buy something else, that's what's really been, it's just vacuumed out, right? Because people don't want to go from 2, 3, 4% mortgage rate to 6, 7%. And even if they would like to, a lot of them aren't even mortgage eligible. It's like around 70% of current homeowners, and it's actually higher than that in many markets, could not afford to buy their current home they own if they had to do it at today's prices, at today's mortgage rates, and based on their income today.
That's like crazy, Lance. I repeated that at 60%, and people are like, almost like they couldn't believe it.
Yeah, and it's kind of depending on where mortgage rates are at any given time, the number of changes. But there are many markets that it even goes higher in some of these coastal areas. On the flip side of that, that kind of speaks to the value of home ownership that we've seen over time. Because if you get in with the fixed debt payments, your locked interest rate for 30 years, if you get a 30-year fixed, and if you get in and you can afford it then, and over time, as prices go up, and then also your incomes rise, you both build equity, and then also your payment relative to your income decreases over time. But the people who aren't getting into the housing market right now because they're just priced out, that's going to be a pain for them for a while because they're staying on the renting side and they're not getting that benefit of the 30-year fixed mortgage rate because they can't get over the hurdle to get into the housing market right now. This relative to, a group 5 years ago, they're in a pinch, right? First-time homebuyers, this is, it's been tough for them the past few years to see all of these affordability deteriorations, prices, rates, insurance. And then even if they stay in the rental market, the rents have went up a lot, right? So it's just been very tough for first-time buyers. over the past few years.
Over the pandemic, we saw, you kind of spoke to it. We saw a lot of people from like New York go to Florida and a lot of California money go to Texas. Do you see any kind of like aftermath or side effects from this? Or maybe like, I wouldn't say like buyer's remorse, or do you feel like, Florida's becoming more like New York or Texas becoming more like, are there adverse effects? Or people like regretting this? Or it feels like people are kind of moving to like the better location and then realizing like, hey, maybe it's the weather that they don't like, or maybe it's gotten more expensive. But it feels like when you start having that many people move in to these plays all at the same time, it kind of, that benefit of moving there kind of disappears.
We've definitely seen a huge deceleration in the pandemic migration that was occurring into the Sunbelt markets. Most markets are still kind of going up a bit, just not like they were before. But you have seen some places see outright net, essentially a correction to migration, right? Where they went up a lot and then they pulled back. And that is why some of these markets, in particular, these boom towns, these second, third cities, they go through boom bust cycles, right? And Austin is seeing that right now. They're in a boom bust where during the pandemic housing boom, home prices in Austin went up 69% on an aggregated level for the metropolitan area. And they saw a huge rush of California and New York residents with a lot of money come in and bid up home prices to, levels that local incomes could not afford. When rates went up a lot and the tech sector got hit, that migration into Austin finally slowed down. Austin then also started to see a lot of work from home folks leave the market that had rushed in. I got some good numbers on that I recently published. And then the other factor is Austin is both not only building at the highest levels for single family homes in the country, almost, they're like second or third, but they're also at the top for multifamily relative to their population base. So they're building a lot of multi, they're building a lot of single family. And as that supply came in and builders used affordability adjustments to move a lot of that, single family homes in the exurbs, maybe also some 10%, 20% cuts on top of it with the buy downs. And then as you saw the rental concessions for a lot of these new multifamily units, that created a cooling effect, additional cooling effect on the Austin market. And they're just kind of working through a correction. And home prices in Austin, depending on what index you look at, Freddie Mac has them down like 15, 14% since the 2022 peak. And the Zillow Home Value Index has Austin MSA down about 20% from peak. But at the same time, U.S. home prices on an aggregated level are about, let's say, 4, 5, 6% higher than they were in 2022. And a lot of that is because despite mortgage rates going from 3, 4, 5, 6, 7, even 8% briefly, a lot of these markets in the Northeast and Midwest and some pockets of like Southern California have stayed fairly tight. Active inventory is still low. And in some of those places, it's kind of been an effect of some people coming back that had left during the pandemic that's keeping them tighter. And then also the fact that there is still work from home arbitrage occurring in the housing market, but it's less of I live in New York, I'm going to buy in Austin. And it's more of I live in New York, but now I have to be in the office 1 to 2 days a week. So I'm going to buy really far out in Connecticut or really far out in New Jersey, in a place where I would have never been able to do this commute 5 days a week. But now with hybrid, I can do it. And so you have still seen the exurbs of some of these major metros boom over the past year to two, even as some of these other markets have moved into correction, because where the work from home arbitrage effect is occurring has just kind of changed.
I feel like those markets are most susceptible if there was like a 2008 moment.
You think the boom bust markets and the Sun Belt are most susceptible?
I think like if you call it like a tertiary market, like, so let's just say where people are, maybe it's an hour and a half outside of New York City that, and it's like some kind of, and it starts to get what you're talking about. I feel like if you buy high in those prices, it'll be a lot harder for that price to recover than somewhere like, 30 minutes outside of New York City.
And I think there's a lot of logic to that premise that you put forward. And what you would just have to point to the places like Austin right now that are seeing it because they've seen, right? And because these exurbs and some of these pockets have taken off so much, builders have slowly come into those markets. So you start to get some of that new construction supply maybe in those deep exurb markets. And the other thing is, while employers have been able to like slowly pull people back into the office, it's been real slow, right? Very slow. If the economy changes, right, and the leverage goes from what's workers had a lot of economic leverage in 2021 and still into 2022, a little less 23, a little less 24. But if we actually saw unemployment move up to like 6%, like quickly, and people are scared of losing their jobs, people aren't going to,
Yeah.
fight over that, right? They'll come back in the office. They're scared. They're trying to get in front of their bosses more. And so, yeah, I hear you in terms of, I would also put them at higher risk. I think that if you go in terms of trying to find risk, a lot of this gets talked about already, but it is probably these markets that have really boomed for Airbnb, like super submarkets, these deep, deep exurbs that got this work
Yeah.
from home effect. And then these second, third vacation, a lot of these vacation markets too, but
Yeah.
many of them have already seen pullbacks, given that the big work from home effect, that big initial work from home arbitrage has really decelerated and seen some pullback.
We're September, let's call it October 2024. In 2 years, October 2026, do you think housing will be more or less affordable? Do you think what do you I mean, that's a
In,
ridiculous question to ask. I'm just
no,
curious.
in 2026.
Yeah, 2 years from now.
Yeah. I would expect the housing market in terms of measured, and I'll actually give you the measurement so you could fact check it. And I don't like to make a ton of predictions because I cover the
Yeah, I'm,
housing.
I'm not holding you to it. Just to maybe
Yeah.
like your thoughts on it.
I would say for the Atlanta Housing Affordability Index, and if you have time, people can go Google that. I would expect that to improve in 2026 relative to where we've been in 24, and definitely better than we were. Not well, I don't mean definitely in terms of like it's 100% going to happen, but I would expect it to be better than it was in 2023 and for October 2023. That's when rates got up to 8%. If affordability has gotten worse, it would be tough to do because you would need home prices to almost go up like 6, 7, 8% a year, because if you've given that this rate move down we've already gotten, and then if incomes are still moving, to deteriorate housing affordability beyond the peak of October would kind of be tough. Now, in terms of like where we are today to 26, it might not be that huge of a change, because we've already gotten the biggest move down in rates. Maybe rates, come in some more. And if we have a recession, they could come up in even more. If we did have a recession, I think that would be the thing that improves these housing affordability measurements, more so than if we're kind of grinding at this, where we've kind of been, where unemployment isn't necessarily breaking. It's just kind of moving sideways, slightly up. If you actually see unemployment start to shoot up really quickly, and if you were to see yields to come down because we have a recession and the 30-year fixed mortgage rate move down quickly, and some of these markets, like we talked about the vulnerability, you could see some of these markets see prices decline for a period of time, move through some type of correction. And so I think that could improve the affordability indexes. But big picture from a buyer on the sidelines, it might not make a huge deal to them, right? Because unless prices come down significantly,
Yeah.
or rates, and the other thing is, if those scenarios play out, do they keep their job, right? And so income's a huge part of
No,
affordability.
exactly. What you
Uh,
just said, I was sitting there. I personally think over the next 2 years, I think incomes will be a little bit more sticky. I don't think they're going to move up at a certain pace. I think you're kind of going to see what was happening outside of like maybe mania from what we saw during like COVID, but also that could boom up in housing prices too. So I just feel like the people are going to feel the same way because the incomes aren't going to rise. And once again, I'm talking about maybe, the people that are priced out right now, more than the people that already own.
One thing, I'd like to share something with the readers, a little plug for Resi Club,
Go
if I
ahead.
can. So I have called this, I think it's the most important metric heading into this year. And I think it proved correct in terms of like figuring out where is there the most upward pressure on prices and where's the most downward pressure. And this is a calculation of where active listings in your market are now versus in 2019. So 2019, I use it because it's pre-pandemic.
Yeah.
And the markets where active inventory has moved quickly back above or to pre-pandemic levels have been the places that have softened the most, right? Have seen the weakness, have maybe seen some of the price give up. And right now that's been in like Austin. And you can see there's about 11,000 listings versus 2019. There was little less than 8,000, right? And at the height of the pandemic housing boom, when homes were selling faster, almost faster than they were getting listed, there was only 3,500 homes for sale in the whole Austin MSA. And so this calculation, I think, is super important to watch. I have hundreds of maps that I share with Resi Club readers, but this one in particular, I think, is really strong. And if you go and let me pull it up, resiclubanalytics.com. You go here, you type in your email, you hit subscribe, you'll get on my free list. I also have a premium list that's 3 additional articles per week, access to my monthly webinars that I do for my Resi Club Pro members. I have a conference that I'm going to be doing every year in November in New York City. Resi Club Pro members get a free ticket to that. If you're an agent and you'd like to use it in your own newsletter, Pro members can do that. And in these stories, the goal is to not just look at one side of the housing market, but it's to look at it from new construction, to look at it from mortgage, to just understand the trends and just really clearly just be explained what's going on across the housing market. And so when things start to take off, like we've started to see a bit of an uptick in refi recently with rates coming in a little bit, I do the numbers and I actually try to find out how big is the size of the refi market and things like that. And then also a super heavy focus on what's happening regionally across the country.
Nice. And that's resiclubanalytics.com, right?
Yes, resiclubanalytics.com.
I follow a lot of people on the housing market, and Lance, I just like it just hits. Like it makes sense. It's digestible. It's like what I need to see that day. It's not just, hey, I need to do like an article to do an article. So if you're listening, watching this, go give Lance a follow. Go sign up at resiclubanalytics.com. Lance, thank you so much for your time.
Fletcher, thank you for having me. Housing, always so much going on. And people can also follow me on Twitter at News Lambert.
Awesome. Well, thank you, Lance. Have a good day, and we will keep them coming. So see everybody on the next one.